So most of real estate financial analysis is relatively straightforward, and you'll often hear industry veterans say something along the lines of real estate isn't rocket science. And while this might be true, one of the most complex, if not the most complex topic in real estate financial analysis is equity waterfall structuring and modeling as far as how each of these structures work and how they're modeled in Excel. Now, I have a few classes on real estate equity waterfall modeling and a video on this channel explaining these in detail, but this topic still tends to be pretty difficult to totally comprehend and often leaves people with some questions as they're working through different equity waterfall scenarios and structures. So in this video, what I wanted to do is break down 5 of the most commonly asked questions I get around real estate equity waterfalls and waterfall modeling and my answer to each. So if you're thinking about raising equity to do a deal in the future, or you have an upcoming interview with a real estate investment firm and want to make sure you're prepared to talk through this concept or prepared for an Excel modeling exam, you're definitely going to want to stick around for this video. Hey, this is Justin from breakintocre.com, and if you're new here, on this channel we talk about real estate investing careers and real estate financial analysis. So if you're looking to break into the industry or do your first or next real estate deal, make sure to subscribe and hit the notification bell so you don't miss any new videos as soon as they're released. So let's first start this video off by talking at a very high level about what a real estate equity waterfall structure actually is. Now, if you've heard of the term equity waterfall or promote structure related to real estate investing, but you're still pretty fuzzy on what the whole concept actually means, I'd highly recommend checking out the video, which is going to pop up at the top of the screen right now, which is also linked in the description below, which goes over this concept in detail. But with that said, if you have a general idea of what a real estate equity waterfall structure is, or you don't have time to watch another in-depth video, the basic premise of a waterfall or promote structure in real estate starts with a basic partnership structure. And that partnership structure determines how cash flows are split between the equity partner that operates the property and is primarily responsible for the major decision-making on the deal, generally referred to as the general partner or GP, and the equity partner that acts as the non-operating capital partner and is not responsible for the day-to-day management of the property, generally referred to as the limited partner or LP. And in short, that equity waterfall structure rewards that GP or general partner for exceeding certain return targets or hurdle rates with a portion of the investment returns that would have otherwise been paid out to the LP going to the GP over those return targets. Now, these structures are commonly made up of first what is called a preferred return and then what's called promoted interest over that preferred return. So for example, you might see a deal with a preferred rate of return of an 8% IRR, with anything over that 8% IRR but below an 11% IRR yielding a 20% promoted interest to the GP, anything above an 11% IRR and below a 15% IRR yielding a 30% promoted interest to the GP, and anything above a 15% IRR yielding a 40% promoted interest to the GP. And again, this incentivizes the operating partner to make decisions that will maximize returns for the partnership as a whole and reward strong investment performance that meets or exceeds return expectations. So with the basics out of the way and an understanding of what an equity waterfall structure is, let's start with the first question I get asked pretty consistently on that topic, and that is the following. My preferred return is an 8% IRR and I have a 10% cash-on-cash return in my first year of ownership, but no promoted interest is being calculated in my model in the first year. Is something wrong? Well, the answer here is no, nothing's wrong, and that is correct that promoted interest won't be earned in the first year of ownership with a 10% cash-on-cash return, even with a preferred return of just 8%. And the reason why is because most real estate equity waterfall structures are IRR based, meaning that the promoted interest and additional hurdle rates are based on an IRR metric rather than a cash on cash metric. And the IRR is much different from the cash on cash return in many different ways, but one of the biggest differences is that in order for an IRR to be a positive number, this requires a return of capital before you'll see any sort of positive IRR values to speak of. This means that even in the case of an impressive 10% cash-on-cash return in the first year of ownership, that 8% IRR hurdle wouldn't even be close to being met. So to use an example, let's take the case of a $100,000 investment from a limited partner, and that limited partner receives $10,000 back in cash flow at the end of the first year of ownership. And even though that investor is probably very happy with that 10% cash on cash return, the IRR for a $100,000 cash outflow and then a $10,000 cash inflow exactly 1 year later ends up being negative 90%, which obviously won't get you anywhere near that 8% IRR figure. In fact, with an IRR-based preferred return, you would have to return a full $108,000 to that LP to hit that 8% IRR value, which aside from an outright sale of the property, likely isn't going to happen on a real estate deal. And speaking of the sale of a property, this leads me to question number 2. And question number 2 is, if the LP hits their preferred return before the sale, does the GP still earn promoted interest every month or every time cash is distributed? And my answer here is it depends, but it primarily depends on the specific language in the partnership agreement that defines when promoted interest is earned. And in my experience, promoted interest is generally only earned at the time of what is often referred to in operating documents as a capital event on a deal. And a capital event is usually defined as either the sale of the property or potentially a refinance of the property as well. And what this means is that in many standard JV operating agreements, promoted interest won't be triggered until a capital event occurs, either at the time of refinance or when the property is ultimately sold to a third party. Now, usually this won't even come into play for IRR-based preferred return structures, since a return of capital is required to trigger this, which usually does require the sale of a property or potentially massive value creation with a refinance. But that said, this is still definitely something to be aware of and to consider, especially if you're in the process of putting together an operating agreement and you're planning to hold the property long-term or potentially for an indefinite period of time. So from here, let's move on to question 3, which also has to do with the cash on cash return again. So question number 3 is, I'm analyzing a deal where the IRR is much higher than the preferred return, but the LP and GP cash on cash return are both the same numbers in my waterfall model. Why is that? Well, the reason why this is because the cash on cash return is calculated net of refinance and sale proceeds, which are those capital events we referred to earlier on in this video. So until that preferred return is hit, many real estate equity waterfall structures call for cash flows to be split what's called pari passu to investors based on their percentage interest in the deal. And what this means is just that up to the point the preferred return is hit, investors will receive the percentage of cash flows that reflects their ownership interest in the deal. Now, in real estate partnerships, it's common that the GP or operating partner will contribute somewhere between 1% and about 10% of the total required equity investment, and the LP or non-operating capital partner will contribute the remaining 90% to 99% of the equity required to close. So to use an example of a $100,000 total investment, assuming the GP contributes 10% of the equity, the GP would contribute $10,000 into the deal, and the LP would contribute the remaining $90,000 into the deal. And if cash flows are split pari passu based on the investor's percentage interest in the deal, this means that a $10,000 distribution in the first year of ownership would be split 10% to the GP and 90% to the LP. And if we run the math on those cash on cash returns in both scenarios, 1,000 divided by 10,000 equals a 10% cash on cash return for that GP, and 9,000 divided by 90,000 also equals a 10% cash on cash return for that LP on the deal. So with many real estate partnership agreements requiring a capital event for any promoted interest to be triggered, coupled with the fact that the cash on cash return includes only operating cash flow and excludes cash flow as a result of the property sale, even cash on cash returns in the final year of ownership will still be equal between the GP and the LP in most cases. And speaking of cash flow splits, the fourth question I'm commonly asked is some variation of, I understand the basic premise of waterfall structures, but how does the cash flow split actually work in practice? Now again, we talk about this in detail in the video I mentioned earlier on in this video, but essentially the math works out to the promoted interest being the percentage of cash flows distributed to the GP that would have otherwise been owed to the LP over a certain return hurdle. So in the case of the 10% equity investment by the GP and a 20% promoted interest over an 8% IRR, a quick way to calculate the total cash flows distributed to that GP over that 8% IRR would be to take the GP's original 10% equity interest plus 20% of what would have otherwise been the LP's 90% of the cash flows over that 8% IRR. And this results in 28% of the cash flows over that preferred return being distributed to the GP and the remaining 72% being distributed to the LP. Now, in operating documents, the legal language is often a little bit more granular than this, which is what these questions are often referring to. And in my experience, the language describing how cash flows are split over a preferred return or specific hurdle rate generally calls out the promoted interest being distributed directly to the managing partner or the GP's managing entity on the deal, and the remainder being split between the members of the company, usually both the GP and the LP, pro rata in proportion to the members' respective ownership share in the deal. And that might sound a little bit complicated, but let's look at another example to make this a little bit more clear. So taking a look at the numbers from this perspective, using our same example, the cash flows to the GP would be calculated by taking 20% of all cash flows above the 8% IRR, plus the GP's pro rata share of the remaining 80% of the cash flows in proportion to their equity percentage in the deal. And in this case, since the GP invested 10% of the overall equity into the deal in the first place, we can calculate the total cash flows owed to the GP over that preferred return by multiplying the remaining 80% of the cash flows by 10%, giving us 8%, and then adding that back to the 20% promoted interest value that was distributed to that GP in the first place. And although this is a slightly different way to get there, this gets us to that same 28% cash flow value going to the GP and 72% of the cash flows going to that LP. So the math is the same and the final result is the same, but for people who are wondering the logistics behind how this is actually calculated in most cases, this is often how legal language is phrased in operating documents between partners. And speaking of legal language, the fifth and final question, and probably the most important on this list, is some variation of, if I change X, Y, or Z part of the model we build in the course, will this model still work correctly? And my blanket answer to all of these questions is it depends, which is both a positive and a negative depending on how you look at it. The negative part of this is that all waterfall structures are not created equal and far from it, so you'll always need to check the specific legal language within your own operating agreement before finalizing any sort of waterfall model on a deal you're working on. But in that same vein, the positive is that all the answers you're looking for will be contained in that partnership agreement on the deal, which will spell out all of the details about how cash flows are split between partners, how promoted interest is calculated, and when that promoted interest is triggered in the first place. So if you don't know the answer about how to model a specific component of a waterfall structure, fortunately you don't have to spend countless hours Googling the information, and you'll have all of the answers in a signed operating agreement between partners. And if your deal isn't done yet, but you have an idea of what you want that waterfall structure to look like, you can modify the operating agreement based on that target deal structure as long as it's agreed to by the LP or LPs on the deal. So if you're trying to build out an equity waterfall model for a deal you're working on, or you have an Excel financial modeling exam coming up, I hope this is helpful in understanding some of the nuances of how equity waterfall structures generally work in practice and how you can adjust your model accordingly. Now, if you want more of a step-by-step guide on how to build equity waterfall models from scratch in Excel, there are two Breaking a CRE courses I'd recommend you check out. The first is the Real Estate Equity Waterfall Modeling Masterclass, which covers the entire build-out of a 4-tier IRR-based real estate equity waterfall model, which is by far the most common structure I've seen used in the US for standalone deals. And if you're working on more complex structures and want to incorporate things like cash-on-cash return hurdles, dual preferred return structures, or catch-ups and clawbacks in your equity waterfall model, make sure to check out the advanced version of the original course, the Advanced Real Estate Equity Waterfall Modeling Masterclass, which will walk through how to build each of these structures step by step from scratch in Excel. And as always, if you want access to all Breaking a CRE courses, models, and some additional one-on-one support, make sure to check out Breaking a CRE Academy, and I'll link that in the description as well. And like I said, all waterfall structures are not created equal, so make sure to leave a comment below and let me know what kind of waterfall structures you're seeing as most common in your market and where you're based, whether it's somewhere in the US or somewhere globally. Make sure to leave a comment and let me know what you're seeing in the market. Now, if you like this video and want to see more content on partnership and waterfall structures, let me know by hitting the like button, and make sure to subscribe to the channel if you haven't already so you don't miss any new videos as soon as they're released. Thanks so much for watching. I hope this was helpful, and I'll see you in the next video.